Start with markets and the latest read on inflation. CPI for October, the headline increasing 0.2% in line with estimates. The core was a little hotter. Here to break down what it all means, Brian Jacobson. He's chief economist at Annex Wealth Management. I'm in the sticky camp on this one, Brian, but the markets are pricing in higher odds of a rate cut in December now. Higher odds even in Jan and March, although they seem to now think we'll be going every other meeting.
Yeah, it does seem like that. When we were talking about it on our investment committee here, we were really looking at the numbers, and I think we agree with you that it is going to be higher for a longer period of time, but that still gives the Fed room to continue to cut, because if you look at real interest rates, which is what the Fed is mostly concerned about, even at around, say, 4.5% or even 4%, that is still at a faster run rate than overall inflation. So even if we peter out here at 2.5% inflation year over year, they could really cut rates down to 3.5%, and then we'd be at a neutral stance. So monetary policy is still restrictive. It's almost as though the Fed, they're just slowly taking their foot off of the brake with the rate cuts. They're not pushing on the accelerator yet.
So if rates are restrictive, so restrictive was 2022, the Fed raises rates after that massive inflation, the markets take a nosedive. I mean, that feels like restrictive policy. Now we have stocks at all-time highs. What does that tell you?
Yeah, that's a really good point. We do see the equity markets at new highs. You also see credit spreads very, very narrow. It doesn't really feel like financial conditions are restrictive. It seems like financial conditions are actually pretty easy, but it's pretty easy for those who can get it. If you are actually, some of the smaller businesses, households, the cost of credit is still very high. The Senior Loan Officer Opinion Survey really shows that banks have heightened their credit standards, and there's not a huge demand for borrowing. So, financial conditions are easy if you want to borrow at these levels. It's just that a lot of households and smaller businesses aren't showing that they have a lot of appetite for borrowing at these rates.
Brian, it's Dom. Credit risk is not really out there. At least that's not what the government bond / corporate bond / high yield markets are telling us right now. We also have liquidity conditions that are, as you point out, relatively easy. Okay. Is there anything that can derail the upward momentum of this market? It seems like there's just nothing that can take this thing down.
Yeah, it does feel like there's quite a bit of momentum here, as you were talking about at the beginning. And that's the thing with momentum. It tends to beget more momentum. But you can get trips along the way. And I do think that we are going to see that, and especially as we get into the new year. You're probably going to see some of the economic data, especially let's think about GDP numbers. If we look at trade data, if people are anticipating that we're going to be seeing higher tariffs, they're probably going to be accelerating imports, and imports, just through the mathematics of GDP calculations, is a negative on GDP. People might be thinking, well, are we building up too much inventory, making too much of a bet on these tariffs? So some of these distortions, I think, are going to really put some worries at the forefront of investors' minds. Right now, there's a lot of that optimism. And at what point are we going to tip towards people thinking about, well, what are the side effects of some of these policies that could be coming down the pipeline?
Can you leave us, Brian, with some kind of actionable advice, given where we are with valuations, with multiples, big argument over small caps, anything kind of tactically that you want to leave us with?
Yeah, I think one of the biggest themes I would really highlight is the idea of bigger deal flow and merger and acquisition activity. A high multiple company purchasing a lower multiple company is a good thing if you're in that lower multiple company. And those are oftentimes the smaller companies within that space. If we're entering into a period where you're going to have a more accommodating Department of Justice and Federal Trade Commission for some of this deal activity, that could really redound to the benefit of small and mid-cap companies. So I think there's a valuation argument for small and mid-cap, a cyclical argument, and then also perhaps, an acquisition argument for a lot of these firms.
All right. And we've been talking about stocks like Apollo, like Goldman, the investment banks, which really reflect that optimism. But I like your point about multiples more broadly as well. Brian, thanks for your time today.
Thank you.
Brian Jacobson.